But, but can you go to YouTube and see what you see on my live stream? I'm not trying to be on it personally. I'm trying to just cast a
also think that we're a
That's what
minority of our addressable market.
baseball.
What about now?
Thanks, Rich. I do want to remind you that our live strategy is beyond just sports. So I'm not going to comment on any of those specific opportunities at this time. But I will steer you back to the letter to show you that our live event strategy is unchanged, and we remain really focused on the big breakthrough events. Our audiences love them, and so anything we chase in the event space or the sports space is a deal that have to make economic sense as well. So live is a relatively small part of our content spend. We have about 200 billion view hours, so small relative to view hours too. But that being said, all viewing is not equal. What we have seen with live is this very outsized positives around conversation and acquisition, and we suspect retention. And we're really excited to keep building on that. We have the Taylor Serrano fight in July. That's a rematch from when they fought the first time on the Tyson Paul fight night. It was the most watched women's sporting event in U.S. history. So there's a lot of excitement around that. The NFL, of course, is a great property, and we're happy to have the Christmas Day games. So we opted into the second NFL game for Christmas Day. So we'll be presenting all-day football again on December 25th. 2025, really exciting. And then today our live adventures have all been primarily in the U.S., but we intend to grow the capability to do it around the world in the years ahead. So very pleased with the progress so far and excited about the future for live sports and non-sports.
Thanks, Ted. The next question is from Matt Thornton of FBN Securities. Do you think video podcasts could perform well as a category on Netflix?
So we're constantly looking at all different types of content and content creators. The lines between podcast and talk shows are getting pretty blurry. We want to work with kind of great creators across all kinds of media that consumers love. And podcasts, to your point, have become a lot more video forward. And today we actually produce a lot of podcasts ourselves as part of our kind of publicity and publishing efforts. So some are really show specific, like Squid Game and Diplomat. Some are genre focused. Some are talent focused. We have a great one called You Can't Make This Up, all about Netflix docs. And they live everywhere podcasts live today. But as the popularity of video podcasts grow, I suspect you'll see some of them find their way to Netflix.
Thanks, Ted. From Rich Greenfield again, how do you create iconic animated franchises? What does it really take to build out culturally relevant animated IP? Is the answer a different team, acquisitions, or something else entirely?
Well, thanks, Rich. Keep in mind, we're relatively new at this, and it's a completely creative process. We've had some hits, and we've also had some misses, so we know we have work to do. But I would point out that we've had some really nice hits with Leo, with Sea Beast, Guillermo del Toro's Pinocchio, certainly Pierce Culture, even won the Oscar for us for Best Animated Feature Film. And the other thing we keep in mind about why we're excited about this space, there's a lot of demand for animated film. In 2024, 9 out of the top 10 most streamed movies were animated features. So just like in our live action strategy, we want to make some, we want to license some. And we have more access today to license than we did when we began in-house animation. And we get to that now through output deals with Universal, Illumination, and with Sony. But the animation team, Hannah and Dan, they're working really hard on a very promising slate of exclusive originals they're going to roll out through 2027, including one called In Your Dreams coming out in Q4, which is really fun, really entertaining, beautifully produced film that I think you're going to love. So we got our work cut out for us, but it's a big prize.
Thanks, Ted. Our next question comes from Robert Fishman of MoffettNathanson. As you think about the competitive landscape over the next 5 years, should investors expect Netflix to move into short form or creator-led content to compete head-to-head with YouTube?
Sure, I'll kick this one off. I think just starting at the macro lens, we've always had very strong competitors, including YouTube, many others. We're all definitely competing hard for people's entertainment time. So we absolutely have to earn every hour that we win. We don't take anything for granted. We don't get anything for free. We wake up every day eager to improve our service for our members and for members to be. We also think, in that broadest competitive lens, that the biggest opportunity we've got is actually going after the roughly 80% share of TV time that neither Netflix nor YouTube have today. We think of that as a real immediate opportunity. And then when it comes to the specific head-to-head competition with YouTube or other platforms like YouTube. We believe we are a more competitive, better service for a certain class of creators and certain types of storytelling. And most importantly in that is that we lead monetization for those kinds of titles. And that means we can provide a better opportunity than YouTube or other services for those creators and those stories. And Ted, maybe you want to comment on the creator and content type expansion.
Yeah, sure. We're looking for the next generation of great creators, and we're looking everywhere. So they're not just in film schools, and certainly not just in Hollywood. Creators today have tools that were unimaginable a decade ago, to tell stories, to reach audience. The question is out there is it premium? Well, some of it is. And we believe we have the best monetization model on the planet for premium storytelling. I think we can help those creators reach an audience. Our model can also support more ambitious efforts for them, can help de-risk them, unlike the kind of typical UGC models. Look at folks like Miss Rachel. She's been in the top 10 every week since she launched on Netflix. Kill Tony right now is killing it with our stand-up fans. We're working with Sidemen. We just launched Pop the Balloon. So we think it's really exciting. When you put this all together, we believe it's the best place for premium content as defined by fans, and the best home for storytellers wherever they're working on honing their skills today.
Thank you. From Ben Swinburne of Morgan Stanley, we are starting to see some of the fear around AI and content creation subside, and major directors like the Russos, Jim Cameron, etc., begin embracing the technology. What is Netflix doing to leverage AI for its creative partners? How meaningful can this be? And are there any examples that you can share?
Well, Ben, there's a ton of excitement about what AI can do for content creators. I read the article too, what Jim Cameron said about making movies 50% cheaper. I remain convinced that there's an even bigger opportunity if you can make movies 10% better. So our talent today is using AI tools to do set references for previs, VFX sequence prep, shot planning, all kinds of things today that kind of make the process better. Traditionally, only big budget projects would have access to things like advanced visual effects such as de-aging. So today you can use these AI powered tools to enable smaller budget projects to have access to big VFX on screen. A recent example I think is really exciting. Rodrigo Prieto was the DP on The Irishman just 5 years ago. And if you remember that movie, we were using very cutting edge, very expensive de-aging technology that still had massive limitations, still created a bunch of complexity on set for the actors. It was a giant leap forward for sure, but nowhere near what we needed for that film. So this year, just 5 years later, Rodrigo's directing his first feature film for us, Pedro Paramore in Mexico. Using AI-powered tools, he was able to deliver this de-aging VFX to the screen, for a fraction of what it cost on The Irishman. In fact, the entire budget of the film was about the VFX costs on The Irishman. So, same creator using new tools, new better tools to do something that would have been impossible to do just 5 years ago. That's incredibly exciting. So our focus is simple: find ways for AI to improve the member and the creator experience.
Thanks, Ted. Our next question is from David Joyce of Seaport Research Partners. The question is, with so much content in your library, what can you do for discovery to help drive further engagement with the platform? Is there anything further structural you can do with the recommendation engine, or is it going to require more marketing?
Yeah, a fact that surprises many people is that even our most popular, most buzzy titles that you're hearing tons of conversation around, those still drive less than 1% of viewing. So that discovery and recommendations capabilities are really critical to unlocking all the value from the investments that Bella's team is making around the world. And we believe, and we continually see this in test results quarter after quarter, that there is more room to improve that discovery and recommendation experience, and therefore provide more value for members, and therefore find the biggest audiences for around the world for our titles. To that end, some examples of this: last year we began testing a new, simpler, more intuitive TV homepage. This is something that we hadn't made big structural changes to in over a decade. And we believe that that will significantly improve the discovery experience on Netflix. We've been polishing and improving that experience based on the input we got from members who used it. And we plan on rolling that out later this year. So that's very exciting and a pretty significant structural shift that we anticipate will move things forward significantly. But we're doing things at the other end of the spectrum too. So we're also building out like new capabilities. An example would be interactive search. That's based on generative technologies. We expect that will improve that aspect of discovery for members. So there's many specific improvements that we've got in works. So a lot more to come in the space, and really, frankly, no foreseeable limit on those improvements in the years to come.
Great, thanks, Greg. Michael Morris from Guggenheim has our next question. It's actually about extra member accounts. How has adoption of extra member accounts trended since launch? Can you share how this offer has contributed to revenue growth to date, and whether you see it as additive to future growth?
We see extra member as a part of our plans and pricing model. So it's an option that provides flexibility and choice for members. It allows them to, tailor the Netflix offering to their needs. We know some members want to share Netflix with family or friends. An extra member gives them an easy way to do that. It's a lower cost way to do that as well. We see good retention and engagement on that plan, which is really important to us and says it's a sort of healthy part of the offering. But while we love it from a member convenience perspective, responding directly to the question, extra member isn't a major driver for our business, and we expect it'll remain relatively small in the foreseeable future.
Thanks, Greg.
I just say to Greg's point, I agree with all that. It is, I think, part of the question. It is still growing, honestly, but it's healthy for all those reasons, but it's just not a big driver of the business.
Thanks, Spencer, clarifying. Justin Patterson from KeyBank with the next question. Alan, who leads our Netflix games business, spoke recently at the Games Developer Conference about making gaming more accessible and achieving mass market appeal. What types of games have resonated on Netflix so far, and where do you see opportunities to improve the user experience to drive even more engagement for games?
Yep, we have learned quite a bit and made some decent progress since we launched games, but we continue to see this as a multi-year iterative journey, much like we've seen and you've seen from us when we launch a new content category or we launch a new country and we develop product market fit and improve that over time. You asked what games have worked for us so far. You can see much of the answer to that question embedded in the genres that we're going after and focusing on right now. So that starts with immersive narrative games based on our IP. Squid Game Unleashed is a really good example. We'll have an update for that game with the latest season of Squid Game that's coming. More recently, Thronglets, which is our Black Mirror-based Tamagotchi-style game that has a dark twist in the end, very consistent with Black Mirror. Another category that we're going after is mainstream established titles. This is Grand Theft Auto, which really worked for us, and you'll see us launch more titles like that in the future. There's also games for kids, being able to give kids a game experience that's free of ads, it's free of any in-app purchases, safe for parents with a subscription. We just announced Peppa Pig game, which is coming soon. So that's an example of that. And the fourth category, which I would say we don't have a lot of data points demonstrated in yet, but we're excited about and we'll be delivering some to understand the space better, is socially engaging party games. Think about this as, either an evolution of the family board game or an evolution of the game show on TV that becomes interactive in your living room. So lots of excitement there. And then you mentioned in terms of areas to improve, there's tons of areas to improve. Frankly, we can improve everything that we're doing, from user experience and discovery and getting to play, but also just in having more compelling games. So that's a real top priority for us at this point. And maybe just a few comments with regard to how we think about investment and growth in this space. We've always said that we were in this to win. We want to invest enough to ensure that we are playing to win, but we also are coming knowing that we've got a lot to learn, and we still have a lot to learn despite all that we've learned so far. We don't want to grow our investment too much until we iteratively develop high confidence that we know how to translate that investment into member value, like the increased retention we see when members play our games. So our investment by our scale is still relatively modest. It's a small fraction of our overall content budget. And as we continue to see incremental proof points, we'll ramp up that investment in a measured way. But we think this approach, this sort of measured growth and planned scarcity, actually yields a better business in the long term. And the long-term opportunity is large. It's about 140 billion in consumer spend, ex-China, ex-Russia, not including ad revenue. We believe in our top-level strategic thesis, and we continue to learn into that executional capability to incrementally unlock that potential.
Thanks, Greg. I'm actually going to bring us back to a question on the results because we do have a late-breaking question from Steve Cahall of Wells Fargo. Can you unpack the key drivers of the expected UCAN revenue growth reacceleration in Q2? Is it mainly pricing, or are there other aspects like advertising or subscriber growth? Maybe Spence, you want to take a stab at that one?
Yeah, sure. So, you saw in our report, our UCAN revenue growth was 9% year over year in Q1. That was a deceleration from about 15% year over year in Q4. The deceleration is, mostly due to pricing timing. So there's a little bit of a sequential quarter tough comparison because we also had the benefit of the NFL games and the advertising resulting from the NFL games in Q4, which also bumped it a bit. But think of it as we plan to reaccelerate again in Q2, and it's really getting the full quarter benefit year over year of pricing. And then also, ads is still a much smaller part of our business than subscription, but ads continues to kind of grow through the year.
Thanks, Spence. And I will now close this out with our last question, which comes from Alan Gould of Loop Capital. His question is, you've been guiding to $8 billion of free cash flow in 2025, and one of your goals is to deliver growing free cash flow. You have historically not spent a lot on acquisitions. Should we assume most of the growing free cash flow is redeployed into share buybacks?
Yeah, thanks, Alan. So there's no change to our capital allocation policy. It's been consistent for years now. We prioritize profitable growth by reinvesting in the business. We maintain ample liquidity. Those are key for us, our top two priorities. And then we return excess cash to shareholders through share repurchase beyond several $1 billion of minimum cash that we keep on the balance sheet. And then anything we use for select M&A. So that's kind of a long wind up to the answer is yes, in the absence of any meaningful M&A, not MBA, any meaningful M&A, we would expect that our growing free cash flow will be redeployed as share repurchase.
Excellent. Well, before we close, first, thank you all for joining us. I would like to take a moment to recognize and to thank Tim Haley for after more than 27 years on our board of directors. He is elected to not stand for re-election. For all of those 27 years, Tim Haley has been on this journey with us. His counsel and leadership has been a really valued part of our success. I'd like to say a special thank you to Tim for his long service and his many contributions to the Netflix board of directors. And let me say also, as someone who's benefited greatly from our time with Tim and has been there with him for most of those years, that through so much change and so much growth, Tim has always offered sage advice and counsel and is an important part of the history of Netflix. Tim has helped shape Netflix into the company that it is today. So many thanks to Tim. And thank you very much for joining us.
It's been 2 weeks since Liberation Day, and we're in a full-blown trade war with China, with tariffs now at 145%, which means the trade war has officially moved from shower to grower. And some people are concerned about this trade war because they want the economy to be good or something. But